Good morning, everyone. My name is Tim Nyland. I'm Managing Director, Portfolio Manager, and Equity Strategist with Zacks Professional Services. And I wanted to thank everyone for attending today and taking time out of their busy schedules. This earnings certain Admiral portfolio project is something that I started back in 2015. And I'm thrilled to be able to share the official rollout of the portfolio with you today. Everyone has seen this advisor tools chart before. This is a chart that I've been showing since Q4 of 2019. And today we're going to take a little bit different twist on it and talk about some of the issues in using the 10-2 Treasury yield convergence as a guidepost. Note from prior webinars that I've done and that you've attended that this 10-2 Treasury yield convergence has successfully preceded each of the past 7 recessions. However, there are definitely devils in the details, and I wanted to bring a few of those to your attention. The first issue is that we all know how difficult recessions are to see coming. By the time they finally start, it's obviously way too late. The idea here with the periods of time that are circled in red is that we see the 2-year literally rising into the 10-year as investors begin to panic and flee shorter term maturities in search of longer term safe havens. And if we take a look at the second issue, is that throughout history we've had a myriad of false starts, and everybody's read about this, everybody's seen them. Probably the largest period of time where we had false starts was back in the 90s. And had you solely relied on this indicator and tried to time your trades around these yield curve convergences, you would have lost out on a lot of potential alpha. And when we look at the most recent period of time here out towards the end, we can see this last point where we had the 10-2 Treasury yields converge, and then it actually took a black swan event to force us into a recession. And so it can happen in a multitude of different ways. Again, the number of false starts surely outweighs the number of real indicators, which makes this trying to time this very, very challenging. And all it takes, as many of you are well aware, is 3 or 4 bad stocks in your portfolio to blow up your portfolio, to literally blow up your performance. So what I want to talk about is the need, again, to reinforce the need to build recession-proof core equity portfolios that you don't necessarily have to worry about timing the market with. And one of the things that I was really, really taken back by, again, this happens every time we go into a recession, is how quickly the buy side responds in terms of rapid equity valuation declines. And as a matter of fact, I'm sure everyone's aware, we're actually seeing a pretty precipitous decline in the overall averages again today. And so, the idea is, this is a price and earnings chart out of the Zacks research system. As many of you are well aware, I rely on this system, do a lot of my analytical research. And this is what the price, and this is price in blue, and we've got a trailing 4 quarters operating or adjusted earnings line here in orange. And you can see that we had literally by March 1st given up all of the equity gains that we had achieved during the Trump presidency. And if you look at the consensus estimates, we hadn't really seen much in the way of consensus estimates reflecting the current environment that the buy side was picking up on. So, it makes it really, really hard to time the market when you roll out of bed on a Monday morning and the futures are already down 1,000 points. And then you figure, well, it might recover the next day, and the next day you wake up, they're down another 1,000 points. It's just a really challenging game. So I took a look at the same exact chart on June 19th, and you can see that obviously the sell side, in terms of their estimates, and when we rolled them up into consensus and aggregated them for the entire S&P 500, you can see that we finally get the earnings recession view in terms of an earnings line on our price and earnings chart. So the moral of the story is that you really can't time the market. I mean, you've always got to be prepared for these events. The sell side consensus estimates are always late to revise downward into a recession, and they're always late to revise upward into a recovery. You must be prepared, and this is where I really preach the use of the Zacks rank, right? Because consensus requires an average of the entire sell side, and the idea is that you're always going to have a few analysts that are much faster, more accurate, and they revise very quickly. And the Zacks rank utilizes the underlying sell side agreement, magnitude, upside, and surprise to determine that indicator ahead of consensus. So that's a really, really good use of the Zacks rank when you are trying to time individual trades in and out of your portfolio, and obviously looking at the overall market. So again, when we take a look at the implications of closet indexing equity portfolios to the S&P 500, when you're looking at this orange line and you're looking with the associated equity valuation declines, you can see how dangerous it is when you're holding these positions through these, what I call earnings troughs into recessions. So the idea is, what does it mean to really have a recession-proof core equity portfolio? And what you're looking at is the price and earnings chart, again, out of the Zacks research system on March 1st. This is the broader 75 stock earnings certain portfolio. This is the original earnings certain portfolio that's been in existence for over 25 years. And you can see that throughout past periods of recession, this group of stocks has literally moved through from an earnings perspective unscathed, and it's helped to shield the underlying equities from real precipitous declines that we would see in the broader proxy, in the broader benchmark. The idea is, since earnings are the lifeblood of equity valuations, if the earnings hold up, the idea is that the valuations for the underlying equities will hold up as well. What I want everyone to see is that even the earnings certain portfolio, when we literally shut down the entire U.S. economy for a few months, did experience a downward revision. I actually call this more of a shift or a step down, and I want everyone to see how quickly that growth trend resumes after the step down. This is important. So this is the earnings certain portfolio, the broader 75 names on June 19th. Okay. When we take a look at the introduction of COVID, this gave me the opportunity to finish up the work that I had started in 2015 on the Admiral portfolio. And so what I did was really start looking into each of the individual members of the broader 75 stock group and looked at not only the earnings revisions, but also any guidance that was coming out and the underlying fundamentals themselves that were being reported, because we actually went through a quarterly reporting cycle as well. And the idea was, back in 2015, when I started this project, it started out with the same objective, to be a 20 to 30 stock portfolio. And the idea was, I was looking for the same exact growth characteristics that can also match the performance of the larger 75 stock earnings certain portfolio. I could get the growth characteristics, but the performance would absolutely fall apart. And that was until COVID struck. And it was absolutely amazing when I put this together that when I created the composite, which I'm going to share the results with you here in just a few minutes, it was exactly what I had been looking for. Interestingly enough, I had about 12 or so original names chosen, and it wasn't until I had a real litmus test of really shutting down the U.S. economy to be able to finish up the work and round out the portfolio to what it is today. So again, this This portfolio is a 30 stock concentrated ultra long-term buy and hold, and it's ultra defensive. You can see that in the next line there. It's got a beta of 0.67 versus 0.79 for the larger ECP, or the larger core equity model portfolio. Okay, little to no turnover with an annual balance periodicity, so it's very easy to maintain. I will walk through the entire constructs of not only the earnings certain portfolio, but the Admiral as we move through the presentation. But I wanted to cover the investment objective very clearly. It is really designed to minimize capital loss, and you'll see that through my performance charts that I'll present. The idea is that if we can minimize capital loss, then we'll pick up alpha in the downturns, and then we can carry that forward by actually having a smoother trajectory of gains rather than the volatility that we experience in the broader markets. These underlying companies' earnings streams obviously exhibit a proven long-term track record of not only earning stability, but being able to move through recession periods virtually unscathed in terms of their ability to deliver on earnings and stable growth. So again, I'm going to mention this a couple times during the presentation. A byproduct of this investment objective is that we have a high-performing and high-yielding, the Admiral portfolio yields about 1.9%. It's an ultra-defensive core equity portfolio, and it does consistently outperform the S&P 500. When you couple it with the tilts that I recommend, I have an entirely separate webinar on tilt strategies, but I am going to review the recommended tilts again today as well. It can be used in conjunction with the existing earnings certain portfolio to give you a little more defense. Obviously, combine it with the tilts that I recommend, and can also be used with another model that I'll be introducing in July called the ECP Dividend Aristocrat Model portfolio. I am going to try to take questions at the end of this webinar. So if anybody has any questions on their mind, I believe in the GoToWebinar console, there's a place for you to type questions in. I'll try to get to and answer as many questions as I can. In the past, I've always taken the questions offline, and clients and prospects have followed up with me privately, but we'll try to go ahead and answer as many questions as we can. And again, I've not done this before, so bear with me if I do have trouble. We will have to take it offline again. So thanks for your understanding in advance. I mentioned the objective of looking for similar growth characteristics. In the case of the work that I do with the earnings certain portfolio and the Admiral portfolio, I'm always looking at a 20 to 25-year trend. And if you could imagine, I've got the bulk of the members that have been the same members since this was designed, 25 plus years ago. So even back then, I was looking back that same amount of time frame. So there's a massive, massive track record of growth stability in this portfolio that needs to be maintained and sustained. And the very top chart, again, this is basically the top panel of the price and earnings graph. Actually, this one in particular is the valuation model, because I can actually put the least squares trend rate of earnings growth over 25 years on it. And the top chart is the earnings certain portfolio. So this is the larger 75 stock portfolio. And if you look at the consensus forecast for longer term 3 to 5 year growth, it's coming in at 8.71. And if we took a look at the 25-year trend in terms of least squares growth of historical earnings that have actually been reported, we're looking at 11.53. And so you can imagine how thrilled I was when I produced the original Admiral this year, and when I loaded the composite into the valuation model to find that my growth was almost spot on, 8.61 and 11.48 for least squares actual growth. And this came after removing 45 of the original earnings certain portfolio names that were basically suspects of the reopen phenomenon that's taking place right now. So you can see names like Starbucks, like Disney, Every time we have another COVID scare, even though they're part of the earnings certain portfolio, they get hit. So the idea is if you want to play reopening names, those are some of the most solid reopening names you could possibly be exposed to. They are still in the original earnings certain portfolio. I'm not going to remove them. As you can see with equity valuations today and the PE multiple that we're experiencing across the broader market, much of the buy side is viewing this COVID pandemic as a one-time non-recurring event and are basically looking past this period. And so I'm willing to do the same one time on the broader earnings certain portfolio, knowing that longer term, those 45 additional names that are subject to the reopen phenomenon that's taking place will catch up long term. And I've got a chart that more or less shows that. So this is the chart that I was literally just referring to that shows the 25-year price performance of the broader earnings certain portfolio against the Admiral. And it also overlays the S&P 500 ETF, the tracking composite, which is IVV.S in the Zacks research system, overlaid against the S&P 500. So you can see how really well our composite facility does overall in tracking, certainly valuation characteristics, but also price performance overall. The key takeaway here is that longer term, the performance of the ECP and the ECP Admiral, those will mirror each other. So you can see that over 25 years, they're almost spot on. Okay. We're going to get into a little bit more variability as we begin to bring this time frame in. And we're looking now at a 20-year price performance of ECP and ECP Admiral. And you can see that when we remove the .com run-up, the outperformance is almost 5x over 20 years. So you can see the S&P 500 without the .com run-up, they really haven't returned a whole lot. If I go back to the previous slide, you'll see the returns were much higher because we had this run-up. And that's the idea with the earnings certain portfolio family, is that the returns are just much more stable over time. You can see we have this huge run-up of the S&P, then this huge fallout. And the earnings certain portfolios, plural, they just kind of chug right through these time frames, and there's not as much variability in the returns. And we see this time and time again, even in the 10-year price performance, right? We're looking at outperformance, and you can see, again, just more stable returns over time. You can see that the IVV and the S&P 500, a little bit of a trough here, and the broader benchmark, or the earnings certain family, just keeps picking up alpha. The 3-year probably shows it best. And you can see the green and orange. These are your earnings certain portfolio. The green one is the Admiral. You can see ZECA for Admiral portfolio, equal weight. And then the original 75 stock members portfolio is in orange. And you can see what happens when we have the market volatility. We pick up alpha literally at every blip. And those returns just tend to continue to compound. Okay. I looked at the returns as of this morning. They're about the same. The ECP Admiral has actually gone positive. I didn't update the slide. The spreads are really what I was more concerned with, and they're about the same. So the Admiral has done an absolutely magnificent job of holding up in this pandemic period, which I'm calling between February 20th and I always try to roll the most recent date I can. I started putting this slide deck together on the 18th of June, so I'm using that as my endpoint. But you can see the Admiral is sitting at about flat, ECP's down about 4.5, and the S&P 500, the IVV tracking ETF's down about -8%. Okay. So the idea too is that we don't want to forget about the tilts. And I've had many questions. I'm sure somebody's going to ask me a question. I haven't looked at my questions yet. I'll do that towards the end, about how we actually fare against the triple Qs or the Nasdaq Composite. And I'm going to talk about that. We're going to look at sector weightings here in just a minute. I've got some specific talking points related to the Nasdaq. The Nasdaq is a completely different animal. and I'm going to address it. And the way that we work our tilts in the earnings certain portfolio addresses it literally spot on. So this is, again, a spreadsheet that I maintain. Anybody who has permissions for Z-Link that wants this spreadsheet, I'm more than happy to give it to them. Just send an email to me, let me know, or contact your account management representative. Let us know. I'll get the spreadsheet over to you. What we're looking at is the tilts that I've recommended, the top 5 S&P 500 names plus Adobe, okay? Alone, the top 5 names, and this is as of 6/18, they now represent the bottom 356 names in total market cap of the S&P 500. So if you want to talk about the broader benchmark being biased towards the weight of the top 5 names in the S&P 500, look no further than this spreadsheet as your evidence of that. It's absolutely shocking. And since I gave this statistic out on the 1st of March, the top 5 names have appreciated against the bottom 5 to the point where we actually picked up an additional company. So we're at 356 now. And the top 5 names market cap percent of S&P 500 is 22% of the benchmark, okay? That's up from literally 10 or 11% just 10 years ago, okay? So these tilts, people have asked me, you know, am I going to have to trade these tilts all the time? Are you going to update the tilts? Yes, I'm going to update the tilts. But to be frank, I've had these tilts in my own personal account for upwards of 6 years now. I don't see these tilts changing anytime soon. I see us potentially adding a couple tilts, but these tilts are solid. They're also the same exact tilts that are bringing the Nasdaq Composites to new highs every day. I'm sure everyone has noticed that. Again, the Admiral portfolio itself is a core equity portfolio. You apply these recommended tilts to basically gain alpha, okay? If you're concerned about allocating money to the earnings certain portfolio because you fear the returns aren't high enough for you, all you need to do is ratchet up your exposure to those top 5 plus Adobe names. Those are the names that are driving the Nasdaq and the S&P 500 returns anyway. So the earnings certain portfolio, along with the Admiral, all they're doing is protecting you from the downside, and they're smoothing out your returns. They're lowering your standard deviation, okay? So you get a whole lot better performance and a whole lot more stable performance just fine-tuning your exposure to the names that are actually delivering the alpha for the broader benchmarks. So the Nasdaq Composite, the top 5 S&P names in the Nasdaq Composite are a 40% weight. Okay, this is huge. The tech sector in the Nasdaq Composite is a 50% weight. So again, I've said it once, I'll say it one more time. It literally just comes down to how much exposure to the top 5 names do you want your client portfolios to have? Because we can get the theoretical returns to any level, and you'll see that here in the performance in just a few minutes. So how are the smaller cap names of the S&P 500 doing over that same pandemic period? To be frank, they're still not performing, and after today, I would imagine these numbers are probably even worse. Yes, we've had a little bit of a value rotation, but as everyone saw yesterday, the bulk of the top 5 names of the S&P 500 all hit all-time highs. And if I look at JP Morgan and a lot of the other value stocks, these companies are literally sitting at their midpoint. They've only recovered 50% of what they lost since the sell-off. And so, again, watch your tilts. We're going to go over the constructs of the earnings certain portfolio in the Admiral here in just a minute. It does not contain the traditional tilt sectors, and we're going to talk about those specifically. But when you start looking at adding in small cap exposure to your portfolios, please be aware that there's a big difference in your sector exposure between what is a small cap growth tilt versus a small cap value tilt, okay? Value tilts on the small cap side are going to be dominated by financials. Growth tilts on the value side will be dominated by healthcare. Healthcare is a defensive sector going into recessions, and financials are something that you want to really stay clear of heading into a recession. So just, if anybody has any further questions about that, they can go back and watch one of my prior tilt webinars where I go into that in detail. It's on our YouTube channel, and I'm going to give the address. And I'm going to also make this slide deck available to all the attendees as well, so don't worry about taking too many notes. So let's just kind of drive home this concept of performance and what these top 5 tilt names have really contributed to, the triple Qs and the S&P 500. So if we take a look at the equal weighted tilt stocks, so this is going to be the top 5 plus Adobe. This is what I recommend. They're basically leading the S&P 500 rebound with a 30.8% outperformance year to date. So that's basically the 26.8% return plus the IVV's negative 4%. If you take a look at the Nasdaq rebound, it's literally an 11.6 outperformance over the triple Q. So it's those names that are literally pulling your triple Qs up as well. So it's the tilts and the technology sector weights that are driving returns. It's been doing this for literally 10 plus years. This is nothing new, okay? I'm bringing this to your attention as a tilt strategy that has been in play for quite some time that is likely to not necessarily change anytime soon. So what I want to do now is spend a few minutes taking a look at some of the differences in the constructs relative to sector allocation and how that relates to performance, okay? So this is the earnings certain, the broader 75 stock portfolio and its sector allocation if you were to do an equal dollar allocation on 12/31/2019. Say you were going to adopt the strategy, you had no idea COVID was coming, but you saw the 10-2 Treasury yield convergence and you said, you know what, that guy Tim said that we may have a recession here in the next 12 to 18 months. We had no idea there was going to be a pandemic, but it was probably a good time to start ratcheting down my risk on my core equity side. So you do this, you end up with these allocations. So your 4% communications relative to 10% exposure on the S&P 500. I want everyone to pay attention to the sectors that are overweight on the earnings certain portfolio. Notice tech is an underweight, and it's still capable of outperforming in core the S&P 500 with a massive underweight, literally a 50% underweight. The dominant sectors are consumer staples, consumer discretionary, healthcare, and industrials. And keep in mind that every single one of these sectors are going to consist of only the best of breed. These are your ultra rock solid, earnings stable, cash flow generating companies, okay? Notice we have one financial name in here. It shouldn't even be in the S&P 500 financial sector. I have no idea why S&P does it, but it's FactSet Data Systems. It's not a financial stock. So when I show you the price and earnings chart, I don't even think I put one in this presentation. I meant to, but that's the only financial stock that's in there. I'd be more than happy to make that chart available if it's not in this presentation deck. But what I want everybody to see is what happens when we take the earnings certain portfolio and we use a 25% tilt towards those 6 stocks. We still have an underrepresentation in tech in terms of weight, and it does a nice job of tapering down consumer staples and healthcare weight. By the addition of Facebook and Google, it brings the communication sector up to just a little bit of an overweight. Consumer discretionary with Amazon goes to an overweight on the S&P 500, and you can see the kind of returns you're looking at. So this is a 6.7% beat year to date for the earnings certain. This is the broader 75 stock group with a 25% tilt over the IVV. Let's move on to the Admiral. And again, one thing I want to mention, when you look at this 46% weight in staples, okay, during the construction of the Admiral portfolio, same thing with earnings certain portfolio, I do not build any of these portfolios with any sort of guidance or restrictions on weights for a particular sector. So there's no, I don't go out and say, okay, it has to be consumer staples because one would think that those are the names that are going to hold up the best. No, I do this after the Admiral portfolio is constructed. Then I run it through the sector comparison to look at the results. And this is what we get, okay? Notice there's no communications. You've got a 6.7, a slight underweight in consumer discretionary, massive overweight in staples, overweight in healthcare, and almost an equal weight in tech, believe it or not, okay? Notice that FactSet Data Systems is still in there as a financial stock. When we take a look at the ECP Admiral core equity portfolio and we apply a 20% tilt, notice what happens. We actually end up with a little bit of an overweight in technology. We bring our communications weight up. We bring our staples down. Okay, I've got in the small chart below, I've got the core Admiral so that you can see it next to what it looks like if you were to apply a 20% tilt, which is, more or less the minimum that I'd recommend. I do recommend we bring down that staples weight a little bit. And it obviously doesn't hurt to bring up the tech and the communications as well. Okay. And this is the performance you're looking at year to date. So this is with a 20% tilt, you're looking at a 12.4% beat. And every single time, we go into one of these corrections like we're doing today, we're just going to pick up a little bit more alpha on the way out. We're picking up alpha on the way down. We're going to pick up a little bit more alpha on the way out. So again, the earnings certain Admiral protects our downside, exposure to the top 5 S&P names, plus Adobe, just like the triple Qs, just like the S&P. Those are the names that are really pulling us higher. Keep your exposure to those names. Okay. Now, I am going to talk about how this thing was constructed, because the way that these portfolios were constructed, it's a very, very regimented process that I go through once a quarter to maintain these portfolios. I'm in the middle of doing it now for the June quarter, so I want to once again share this process with everyone. The original earnings certain portfolio was constructed, again, 25 years ago. It was a project to be able to calculate a market implied equity risk premium. So we ran it through a valuation model. We were able to determine a group of stocks that could be our market basket of securities for equities. And we were able to more or less produce equity risk premium series. I still calculate this each week for Zacks, and it's an absolutely phenomenal macroeconomic headline risk series to look at to determine the likelihood of future PE multiple expansions and contractions, or what percentage of historical expansions or contractions could be attributed to macroeconomic headline risk increasing or decreasing. So it was a really, really important research project that I was involved in, and the earnings certain portfolio was born out of that. Again, key takeaway highlighted here in yellow. We're not managing this for performance. We're not managing it for sector exposure. It's literally a byproduct of this constant quest for what I call earnings stability and the growth characteristics that go along with that. So again, extremely low turnover. Many of the members are original ECP members from 25 years ago. In 2019, there were no changes in membership to the earnings certain portfolio. So again, really, really low turnover. These are really boring companies. When you see the names, you're going to be like, oh, okay. But when you put them all together in a portfolio, it really makes a lot of sense. The beta, again, of the broader ECP is 0.79. The Admiral is only a 0.67. So really, really nice beta. Gives you that really, really nice downside protection. These are legendary, mature, dividend aristocratic names. These companies have literally withstood the test of time. Again, I like to be able to call this, to allow advisors to call this their own, right? Because we're giving you the cake, and you can put whatever frosting on it you want. There's many use cases. I've got 4 of them outlined later in the webinar. But keep in mind that in the core portfolio itself, There's no Apple, there's no Facebook, there's no Microsoft, Netflix, Amazon, Google, no IPOs, no pot stocks, no Spotify, no Fox, none of that. So you can apply your own tilts. Everybody has their own conviction tilts, their own conviction bets they want to make. Clients have their own stocks they want to hold. You can blend that together. The dividend yield is obviously outpacing the 10-year Treasury by a factor of 2x. It's meant to be implemented as an equal dollar-weighted portfolio, and rebalance is only necessary one time a year. Most of these companies in these portfolios, when they take off, they tend to run for 6 months to 9 months. So if you're just rebalancing every quarter, I've done all the back testing on the rebalance periodicity, and you're literally just taking away your own returns by rebalancing it too frequently. Again, use the Zacks rank. I do recommend that for making entry points. Keep in mind that the Zacks rank is not a factor that is utilized in the creation or the maintenance of any of these portfolios that I'm talking about in the earnings certain family. Keep in mind that these are ultra long-term. Zacks rank is a short-term indicator, and it is very likely that some of these stocks that have been in the earnings certain portfolio since inception have gone through, more than 20 or so 1 to 5 cycles between buy and sell. Again, it's just not anything that I take into account when creating the earnings certain portfolio. So let's just talk really quickly how it was constructed. 25 plus years ago, we started with the S&P 500. We stripped out all of the tilt sector companies. So anything that could be potentially correlated with changes in interest rates, like financials, energy names, precious metals, commodities, utility sectors. And we also took out any companies that had any sort of distortions related to discontinued operations, mergers, any sort of financial irregularities. Those were removed as well. Again, we were doing a research project related to calculating equity risk premium, which is actually part of an interest rate series. So the resulting list was only 250 or so names. We added back 150 like names, and we produced a universe of 400 names called the Standard Industrial Proxy. That universe of 400 names is still available to all of you today. It's in Advisor Tools under the Equity Select lists, and you can see all 400 of those names. That is literally what I use to determine the pulse of the U.S. industrial economy. So if we had a true market basket of securities, one would think that we could split that universe of 400 names into an even 200 growth and an even 200 cyclical names. And in fact, I've done this. We still maintain these for you today. They're in Advisor Tools and the Zacks Research System. One of them is called the Growth Proxy. The other one is called the Cyclical Proxy. And the 75 most earnings stable names from that original universe of 200 growth companies is where the earnings certain portfolio originated from. Again, in 2015, I began researching the idea of the ECP Admiral, and in 2020, I was able to actually finish the work. So I'm actually thrilled about this. Let me show you what some of these underlying stocks look like, because I think this will really hit the nail on the head for many of you that have questioned what kind of companies you're actually investing in. And it's different when you see the names on an institutional analytics research platform like a Zacks Research System. When you look at their price and you look at their earnings. If you look at Amgen, this company has literally just ripped through previous recessions. It has extremely stable earnings, and it does so even through this COVID pandemic as well. This is a 25-year price and earnings view. And you can see periods during the dot-com run-up. We traded a tremendous multiple expansion. You can see price just running away from earnings growth. And then you can see we had a valuation contraction here. PE multiples contracted. We got down to about a PE multiple of 10 here. And then we got some confidence after the recession, and we've had a multiple expansion contraction. But rock solid earnings performance. These are the names that are in your portfolio. Church and Dwight. Okay. I always make the joke, baking soda and Trojan condoms aren't really going to go out of style regardless of what's happening with the broader economy. And you can see that this company just continues to deliver, and this is one of the core members. AmerisourceBergen, again, healthcare, just continuing to deliver right through the recessions. Notice the stability of the orange line, okay, and its ability to basically protect price during these volatile periods. So these are the companies that we're avoiding, all right? So everybody knows about Ford being a cyclical company. I don't know if anybody's ever really seen it visually like this. But anybody that receives this deck can use this in their client meeting to say, hey, this earnings certain portfolio, this methodology, regardless if you combine it with your own existing methodology or you take it in its entirety, you can avoid these names. These are the names that can be absolutely disastrous for your portfolio to sit on long term. There's a time and a place for Ford Motor Company. It just doesn't belong in your portfolio all the time. Okay, it's a cyclical name. Citigroup really never recovered. Okay, a financial name. Delta Airlines. I mean, look at the volatility in these earnings. Schlumberger. Okay, there's a time and a place for Schlumberger, but you don't just sit on it. So where do I find these portfolios in Advisor Tools? You can see I have the earnings certain Admiral portfolio highlighted. It's under the equity model portfolio, and the standard industrial proxy, the growth proxy, and the cyclical proxy are all under the equity select lists. Keep in mind that I do a much more thorough job of going through the underlying constructs of the earnings certain portfolio itself in my very first webinar. And here's your equity select list. And so I want to make sure that everyone's aware when you receive this deck, you'll be able to click on this YouTube playlist, and it has the original earnings certain portfolio presentation or webinar that I did back in 1st of March, the portfolio built to outperform in a recession. It has a lot more detailed description of the constructs in there. This is the Tilt Strategies webinar that I recommend everybody watch. And this webinar that I'm doing right now will end up replacing the 3rd webinar. And then the 4th webinar will end up being replaced in July when I do another webinar on the Dividend Aristocrat portfolio. Okay. So I want to talk about some use cases, and then we can get into some questions. Again, there's no exposure to tilt sector industries such as financials, commodities, precious metals, energies, utilities. There's none of those names. I've already spoke of the fact that in the core portfolios, there's no Apple, Facebook, Microsoft, Netflix, Amazon, Google, no IPOs, no Teslas, no pot stocks. So the idea is you can apply your own conviction tilts. You can do it with ETFs, you can do it with equities, whatever you want to do. Just start thinking about how you can blend this concept of recession proofing your core equity portfolios in with what you're doing now. The first use case is that you can obviously just take the earnings certain Admiral, it's 30 stocks, combine it with the 6 tilts. You've got a 36 stock portfolio. You do a 20% allocation to, at minimum, to the tilts that I'm recommending. You've got a rock solid growth portfolio. Use case number 2 is to basically apply your own tilts. So keep the Admiral core, and then utilize our market strategy piece from the monthly investing update and asset allocation. Or use your own tilts around timing interest rate exposures to financials, commodities, precious metals, energies, utilities. Again, I don't recommend any of those sectors to just be sitting in your portfolios long term. They can be really, really disastrous as we head into these sort of corrections. In the very first webinar I did, I showed all of these sectors. These are all your leadership sectors for the demise of the S&P 500 or the broader benchmarks once you start heading into a recession. So if you can avoid these sectors in your core and tilt around them instead, you're going to be much better off. Getting exposure to these sectors on the way out of a recession is fine. Don't sit on them long term into another recession is the idea. The use case number 3, using the ECP Admiral as an ultra defensive core. And you can basically hedge the downside risk of any one of your portfolios while leaving in place all your upside capture. That's the beautiful thing about this. So you can take, any any allocation you got. Even if you want to use the broader 75 stock Admiral, remember over time the performance of the Admiral and the broader 75 name benchmark, those are gonna basically equal out. But if you want to get ultra defensive, you can just double weight, the 30 Admiral members, and that'll bring down the beta of your portfolio. And then obviously you can just use that as a pick list. So use case number 4 is if you don't want to implement the portfolios themselves, you can combine the 75 stock membership with the 50 stock focus list. These are 50 stocks we expect to outperform the S&P 500. You'd have basically a 125 stock universe of the most reliable performing stocks in the U.S. equity market. So if you look at the focus list available in Advisor Tools, you'll see, a few financial names in there. One of them is JP Morgan, one of them is Bank of America. Those are my 2 favorites. If you have to have exposure to the financial sector at some point, when the interest rate environment becomes more favorable, I'd be a total fan of that. Get exposure by looking at what's in the focus list for individual stocks that are for sectors not represented in the earnings certain portfolio. Okay. My contact information is here. I have had the opportunity to speak with so many of you, and I thank you for following up with me. I really enjoy speaking with you and doing the strategy sessions that we do. Feel free to reach out. Our help desk is phenomenal. You can email anyone. We can get a response. You can get directly to me. If you want to talk to me, that's fine. I want to take some questions. I'm sure I have some. So I'm going to go ahead and open it up. What kind of sector differences are there between your portfolio and the S&P 500? Hopefully I've answered that question. Got here. All right. Bear with me a minute. I'm trying to open this window up. Okay, that was from Michael Sheldon. So hopefully I've answered that question. If not, Michael, follow up with me offline. Would this be suitable as a standalone for a trust account? That one came from Morris Armstrong. Absolutely. There is no better core equity portfolio than a rock solid, earnings stable group of companies. You're going to be a lot safer in those names than you are going to be subjecting your clients to the volatility of the broader S&P 500. This next question is from Aladdin, and it says, will you be providing the portfolio content and how to rebalance it, or will we have to subscribe to service? So that's a really good question. The Admiral is included if you have the equity model portfolio entitlement. It's not expensive. If you don't have the equity model portfolio entitlement, and all you have to do to see if you have it is just go under the research tab and see if it's there, just contact me or contact your salesperson that sold you ZRS, and we'll see what can be done about that. And as far as the rebalancing is concerned, it's extremely simple. It's an equal dollar allocation, and it's literally what you want to do is allocate your weights to your tilt stocks first. So if you're going to do a 20% or a 25% to the tilt stocks, do that first. Take the remaining balance, divide it by 30, and then revisit that in basically a year. Okay, and doing it any more regularly than that is really not that necessary. You can if you want. It's not going to really help improve performance per se, not from what I've seen. Related to that question, though, we will be making obviously any membership changes to the earnings certain portfolio, to the Admiral portfolio. When I complete my June rebalance, if you like call it a rebalance, I basically go through the analysis again and revisit all the names and do my analytical work. So far, I'm not planning on replacing any members, but I haven't been through all of them yet. But we will make an announcement either way, come the 1st of July, whether we're replacing a company or two, or whether there's no changes. So everyone will be notified of that. Okay. I already own Research Wizard, and I'm wondering if you can provide a scan parameter model to run for this portfolio, as well as a periodicity to run for rebalancing. There is not necessarily a scan parameter for Research Wizard. This person that asked this question is going to want to follow up with myself or their salesperson to see what we can do about getting you the list. The rebalance is annual, and I hope that answers your question. Aladdin also wants to know if this is options tradable. Certainly the underlying members are option tradable, and I always recommend writing covered calls once the PE multiples get to their being on the larger side of their band that they trade in. It's a great way to generate additional alpha. Writing covered calls is just, it's excellent. So you can do it with the individual members, but not the overall portfolio. Is this always a growth-focused portfolio, or does it include any type of value or blend names? What about mid and small stocks? Thanks. The idea is that the search for earnings stability tends to yield growth names. I don't go looking for growth names, but in search of earnings stability, the ones that end up being the growthier names end up being the ones that end up being selected, and there's a multitude of reasons for that. So there's really no value names in here. There's really no blend names as well. We run into some mid-cap names, but rarely a small-cap name. And the reason for that is because these companies need to have at least 20 years worth of history to qualify. So there's very, very strict provisions that I use to select these names. And that was from Sheldon, and he's already left. I'm going to take a couple more, and then we'll end the webinar, and anyone can send me an email or follow up with me offline. So as far as earnings are concerned, given where we are currently, hasn't the Fed really replaced the E in the PE ratio? I think the answer to that question is we've probably got more liquidity now than we've ever had in the markets. And I'm not sure if the Fed has actually replaced the E, or if it's really a factor of the buy-side community now looking out not just 12 months forward, but actually 24 months and beyond for the actual earnings recovery. And I think that part of that equation is obviously all of the Fed liquidity that's been injected into the system. I think that in and of itself is what triggered the buy side to say, you know what, we're going to go ahead and just overlook this recession. We're going to focus on the recovery, and that is really what we're seeing. So with that, I'm going to go ahead and end the call. I appreciate everyone's time and attention today, and please feel free to follow up with me offline, and we will make the slide deck as well as the webinar available to all members that attended by the end of the day. Thank you very much.